Are you or your clients looking for a regular income solution with compelling returns to diversify your portfolio? If so, Neighborhood Holdings may be a great option for you. Listeners of this podcast will appreciate that public markets can be turbulent and finding a good private credit fund can be tough. But Neighborhood's track record, transparency, and investor alignment sets it apart from the pack. With nearly 10 years of consistent performance and a target net yield of 8 to 10%, Neighborhood has a track record of providing monthly income to investors without the volatility of public markets. How do they do this? Where banks invest in mortgages up to 95% loan to value, they also make borrowers jump through a lot of hoops. Many borrowers in transition aren't able to meet those hoops. Neighborhood has partnered with banks and brokers to provide quality borrowers with temporary financing secured by first mortgages at an average loan to value of less than 60%. Where other mortgage funds might take more risk by lending against construction, bare land, or jumbo loans, Neighborhood is focused on your average residential borrower who owns the average house in the neighborhood. Plus, their variable rate with a floor mortgage pricing benefits investors when interest rates go up and mitigates downside risk. Check out the link in the description or visit neighborhoodholdings.com to view the offering memorandum or speak to your financial advisor for more information. That's neighborhoodholdings.com/Loonie Hour. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to Loonie Hour, episode 166. As always, joined by my three amigos. We got one more coming on today, but we got Keith Dicker here, Rich Diaz. What's going on, Boomer?
Christmas season. So Mrs. Icecap and I, we've decided, it's not a big family decision. It's just something, you do. So we started watching as many Christmas movies as we can leading up to Christmas. So, and us, it takes us probably 3 nights to watch a whole movie. So far we've done, we take turns choosing. So she chose Elf, the Will Ferrell one.
That's a good one. Yeah.
Yeah, it's okay. Yeah. Santa, it's Buddy. And then I came back with The Night Before. This is Seth Rogen and his buddies in New York City. Do you know that one?
No.
It's good, Rich. Right up your alley.
Is it?
Yeah.
Okay.
Yeah, actually, it's really good. It's quite funny. And then Mrs. Icecap. I almost said her name. Not the name. Almost came out. Mrs. Icecap chose Daddy's Home 2.
Are you sure that's a Christmas movie?
Yeah.
It is actually. It is. I hear you. I get you.
Someone's gonna be
Okay.
switching his shirts soon.
Yeah, I think
switching
so.
shirts and watching dirty movies.
It's that time. It's that time of year, guys. We're on with two more Loonie hours, right, for the year. Then we're done.
Yeah. We're working on like anyone that's tuning into the show here, we're gonna probably do some like a live Q&A, maybe on like YouTube or something. We'll keep you posted. But this week's episode.
Maybe we should all go to Ben's house. We do it from his place. Have a rager.
We can ask
Christmas
him
rager.
live.
It's too cold.
So we got the Bank of Canada, of course, out this week. We had some Canada jobs data, US CPI, PPI, ECB, some updates on sort of taxes and tariffs. And so, there's a lot going on leading into the new year. And we thought no better guess than, what is it? Second or third time, Ben Rabidoux of North Cove Advisors, also known as Bob Sacamano. I love
Seinfeld. Yeah, Seinfeld reference. Yeah.
Someone I don't know was one of our Loonie Hour listeners that was like,
it was.
You guys always talk about it. Ben. He's like Bob Sacamano. So, anyways, if you get the Seinfeld reference, you'll know. But he's the recurring guest here, so we thought we'd get him on because, he's the guy. He's the man. He's
There's lots of good stuff that he's been right about, and I've been wrong. And I forgot my Twinkie. Oh shit! Oh no! Oh, I'm a bad
the rules.
I know I'm a bad person. I'm sorry. I completely forgot. I got caught up in a call, but I know the rules, and I will be eating a Twinkie later tomorrow. tomorrow, next week. Oh well. So what's
Well,
going on?
without further ado, I think we should bring in Ben Rabidoux right now. Ben, welcome back to the Loonie Hour. What is this? Is this take 2 or take 3 with you?
It's at least 3.
I think it might be
Daddy's
4.
home 3.
I think that's winning, isn't it? 3?
Am I the first 3-time guest? Do you know?
No.
Yeah, I think you just
Are
topped
you?
Ron Butler.
Yeah, that's it. It's Ron Butler.
No, Ron's only been on twice. Suck on that, Ron.
Oh man, so it's here
Well,
we go. Okay.
We had the Bank of Canada. We teed up last week's interview with Twinkie Bet. So we had Ben. You had 50 basis points. You texted us off air. So I was right. I made the assumption that you were going to be 50. So you were right. Keith was right. Rich, me and you, buddy. Rich,
as usual, I'm wrong. And
basis point hike.
I forgot.
I'm surprised you weren't at 50 on that one, Steve. You call yourself a realtor? What the hell is that?
I know, man. I'm the black sheep in the industry. But I don't know. I just I don't know. I don't know what the fuck I was thinking, to be honest.
But it got pretty, hindsight is usually pretty good in our world, right, lads? And but the odds went from between 25 and 50 to 50 very quickly, after we had that employment data that came up. So we'll talk a little bit about that maybe. As Steve is
2 weeks prior,
there.
Keith, 2 weeks prior, I think it was only they were pricing at 10% odds of a 50 bip, which seemed way wrong to me. And where I think it gets a lot more interesting now is what they're going to do going forward, and whether you buy the narrative that they're going to dramatically slow the rate of cuts. I think that's something we should discuss.
Do we want to talk about the employment data first, and then the lead in to why the market started to price in more and more cuts? Because I think, Ben, you had a mother of all memes and tweets.
Oh man,
which one was that?
I don't know. It was the one about 45 versus 51. Maybe you want to just talk a little bit.
Oh yeah. Just how much of the jobs number was due to public sector, and that's so. I was looking at the numbers over the last 5 years, exactly 5 years. You've had about 45% of the job creation in Canada has been public sector. That's not, everyone immediately wants to throw shade at that, but you got to remember that includes healthcare workers, that includes education, includes a lot of things that we need to have growth in, particularly given the magnitude of the crazy population growth we've seen. So it's not like it's all just middle management, just paper pushers sitting at a desk in Ottawa. You know what I mean?
Still short a lot of doctors, I can tell you that.
However, though, I was looking at that as well. And if you compare public sector employment across the OECD, which includes lots of countries that have public health services and are, as Keith might call them, commies or socialist countries, Canada is absolutely in the top sort of third of that country. So that, we are in the same sphere as a... So just, it's not good, because you're right. I mean, too much of it is public sector employment. It's not at all clear that these people are productive or not. And then we know, because public sector productivity series are flat. But we are now getting into some rarefied air with respect to people who are on the government, at the government trough, to put it.
So let's
let's just go first. We were sort of flopping around a little bit to get started because we're all excited to see everyone hanging out here together again. But for everyone listening, the Bank of Canada just cut by 50 basis points. And what did they do at the meeting before this one?
Another 50.
Another 50. The meeting before that?
It's 25, wasn't it?
25.
Was it 25? So now we've got we're
100. No, we're 100. What did they got now, Ben? 175.
Yeah.
So we've gone 175 very, very quickly. And this is the perspective we have a conversation about today. Their view all the time, you listen to the presser and then you listen to the ECB this morning, everyone. It's all about, we are inflation magicians. We're able to control this whenever it gets out of hand, like that. And yet, I think what you'll share with us, Ben, and I think what we've been talking about quite a bit, they're not necessarily cutting rates to try to catch up with inflation, the rate of inflation slowing, because it's not coming down, of course. It's more from our concern is that it's really, you know, we're walking straight into a growth problem coming up.
Yes.
Yeah.
Yes.
So why don't
I
you
think
sort of
that's
go a little bit
exactly
on
right.
that, and why don't you share with everyone, you know, what you think, is this a major concern, or is it, hey, maybe it's under control now, or something like that? So what are you seeing with your research, what you're doing?
Sure. Well, let me take a step back. So as you guys know, I've had a view that the market has been underpricing the magnitude of rate cuts that would be necessary to kind of put a floor under things. And that's been a consistent theme. I was saying, you know, I think I was consistently saying we were going to get 50 BIP cut in December. I still think there's another, this is going to be very unconsensus, but I think there's another 50 coming in January. So what I was seeing is, if you look at the indicators around kind of business health in Canada, we've seen like everything's just flashing red. So if you look at the delinquency data for small businesses across all loan products from Equifax, it's like, you know, we're now above the 0809 peak. You're seeing like a dramatic move, and it looks very different than the slope that you're seeing in the US. So you're seeing some signs of business credit issues. You're seeing business insolvencies. We had that big spike in the first quarter when you had all like the, you know, SEBA repayment stuff hit. You had a big spike, and then it kind of leveled off a little, and now it's ticking back up again. So you're seeing business insolvencies accelerating again. And then credit to the business sector is starting to look a little soft, so the banks are tightening credit. And then if you look at the number of active businesses, it's declining in Canada. And so, you know, I've had a view for a while that the business sector is hurting, and it's just not yet showing up in the labor force data in the way that we would have thought. But I've got a bit of a theory on something that I think is happening in the labor market, that this is very non-consensus. And I would say that this is not like a really high conviction view, but I think there's something happening in the labor market data that's kind of giving these weird signals. Okay. And so one of the things we know is, if you look at the headline jobs numbers, they keep coming in above expectation. Like every month, it's like they're expecting 20, it comes in 40, expecting 25, comes in 50. It's like the headline number keeps improving, keeps beating, let's say. But you look at the secondary data, and in particular, if you look at like the number of unemployed Canadians, we're up to 1.5 million unemployed Canadians. We haven't been this high since before the pandemic. Okay. And the share, or I should say that the kind of the pool of unemployed Canadians who've been unemployed for 6 to 12 months is expanding quite dramatically. Like you're talking like 70% year-over-year increases, very dramatic increase. And so you've got this strange situation where the headline numbers still look okay, but it's very clear within the data that if you're unfortunate enough to lose your job, you're not finding another one. And so like, how do we explain that weird churn? And I think what's going on, you guys know I've been very vocal for a while that I think we have rampant fraud in the temporary worker program, particularly related to labor market impact assessments. And so to frame that, I put a tweet out not too long ago where I looked at the number of labor market impact assessments that have been approved over the last year relative to the growth in payrolls. And it's considerably larger, right? So in other words, like there's almost no way to get to that number of labor market impact assessments being issued without there being some level of fraud. Okay. And
wait,
so
what's a labor market impact assessment?
Okay. So if you are an employer and you want to hire a temporary foreign worker, you have to show the government that you tried to meet that job requirement or fill that job locally from the local labor force. And it's a very low bar to clear. It's a 99% approval. It's effectively a rubber stamp. If you say the government that you need one, they rubber stamp it. That's the experience. Now, what's important to remember is if you want to come to Canada on a permanent basis, you want to get your PR, the way that we allocate PR in Canada is it's based on a point system. So we assign each applicant a number of points based on their age, their educational attainment, prior work history in Canada. And importantly, you get 50 points if you come to Canada on a work permit, which means that if you come to Canada with a work permit, it dramatically improves your odds that you will get permanent residency. So what everyone has realized is if you get this labor market impact assessment from the government that allows you to hire a temporary worker, that now has a lot of value to someone wanting to come to Canada, to the point that those are being effectively sold to applicants via these third-party recruiters. Okay. And you can research this, and CBC has been writing about it, but this has been a known thing in the industry for a long time. So I would contend that one of the dynamics that we're seeing is you have this form of hiring that is sort of agnostic to the underlying economy, because it's being driven by, considerations outside of, like, let's say domestic demand, for example, right? People are paying to come to take that job. And so that's why you continue to see the headline numbers look okay, even as you get this dramatic swelling in long-term unemployment, where it's clear that Canadians can't actually find jobs, right? So, like, again, this is not like a high conviction view, but it's just something that I'm like kind of teasing out a little, because to me, the labor market data is weird. Yeah.
So yeah, just to kind of understand that correctly, what you're saying is that basically people are essentially these temporary workers are basically paying for a job. So that's making your headline labor statistic numbers look a lot better than they otherwise would be. But from what I hear and whatnot, is that a lot of these jobs in many cases don't actually exist. Is that true?
Well, they exist on paper. That's correct.
Yeah. You're not actually I've heard of these stories from these recruiters that basically, you're paid to become a bricklayer, but the guy doesn't actually lay any bricks, doesn't actually work for the bricklayer, but on paper it says he does. Yeah. But meanwhile, he's driving, Uber Eats.
Right. Or more likely, he's paying the employer.
Right.
Right. So in other words, so for example, you could, and I think we talked about this last time I was on, guys, but one of the, like, our immigration system is just so fundamentally dishonest right now. It's so right to be overhauled. And one of the things that drives me nuts is if you are a franchise owner, and I'll pick on Tim Hortons and I'll pick on Canadian Tire because they've been in the news for doing exactly this shit. If you're a franchise owner, you can take those labor market impact assessments, pretend that you can't fill a job locally, you can sell those, and you can collect potentially $25,000 for each one. So if you hire 10 foreign workers, you are paid $250,000. This is happening. And I would suggest to you it's happening in scale. And I think that's part of the reason why you're seeing this weird dislocation between the headline numbers and these sort of secondary indicators of labor market slack.
But how does that square with the fact that the public sector is driving the employment growth? Is it the public sector that's getting paid to hire foreign workers?
No, because so if you look at it's not just the public sector that grew. Okay, so you had contraction in certain industries, but if you look, for example, last month, food services and retail were huge growers. Yeah, right. So 15, remember, it's like 15, on net. Right. And so, like, what's going on there, right? Even as you've got this big pool, you're seeing youth unemployment surging, you're seeing long-term unemployment surging, but yet you get this, like, huge growth in combination food services and retail trade, which is like right in the wheelhouse of where this fraud would be happening. So, I don't know. It's just it's curious.
Can you walk me through what's happening while we're on the jobs side of it? What's happening in the construction sector in Canada? Because from what I am reading very loosely, it seems like the construction, like the employment in the construction sector, is holding up relatively quite well. Is that fair to say? Or
Yep, it is. It depends on where you are. If you're kind of in the finishing trades, you're okay. So if you're somebody who's pouring concrete, like pouring the foundations, you're starting to feel a slowdown, right? If you're in the early stage, you're starting to feel that slowdown. So if you look at really what drives construction employment is the number of units under construction, right? It's not necessarily housing starts, it's how many units are being built. And that's still pretty close to all-time highs. But if you look at some of the latest housing starts data, you're starting to see where that's really starting to fall relative to a year ago. So you're down 30% year over year. And so you're seeing signs that number of dwellings under construction is going to start rolling over, right? And particularly in places like Ontario.
And those housing start numbers, from my perspective, seem more elevated than they probably should be. Like, I think if you look at what's happening in the pre-construction market in terms of pre-sales, they've fallen off a cliff, 27-year lows in the GTA, 10-year lows in Vancouver. Mm-hmm. I mean, I can't think of too many guys that are actually out there developing new projects today. Some of them are still jamming through rental projects, but in terms of like actually pre-selling condo units, I mean, it's the market's dead.
Yeah, those starts will be down 70% this year, 70. Like I think that's baked into the cake. So if you just do a chart, I've got this chart. I think you've seen it, Steve, but it's you do like rolling 12-month pre-construction sales relative to rolling 12-month condo starts, and they fit on top of each other perfectly, but with like a 18-month to two-year lag, which makes sense because of course you have to pre-sell a condo before you get the financing from the bank to build. So there's this natural lag there. So you can if you just see what pre-construction sales are doing, you know exactly what condo starts are going to look like, and they'll be down. I think 70% this year is probably the right number.
Are you pretty worried about employment in the construction sector? Is that like a 2020? Is that a mid 20 to late 2025 concern, or is that coming sooner?
Like, I think that's coming sooner. What gets tricky to figure out is like you just keep seeing just such strength in the rental segment, right? Like so, right now, housing starts are half rentals.
Yeah.
So, and you guys know my view. I think population growth is going to fall a lot, and if the government's correct, it's going to go negative for 2 years. So the need for this many rentals under construction is just, I don't think is there. So
you're pulling on another thread that maybe I won't go too deep into, but I think there's going to be a bit of a problem with the CMHC rental program, which is basically what they've been doing is they've got a lot of these inexperienced developers that are out there, and they're loaning 95% loan to cost on the construction side of the rental market to spur rental housing. And to your point, right? If you cut immigration to basically zero, no population growth, and you've got record number of units under construction, we're seeing now rents in Vancouver down 10, 11%. They're down in Toronto. They're falling in other metros.
Yep.
And you've got I think CMHC could be on the hook for potentially some of these rental projects. 95% loan to cost. I mean, that's a lot of leverage.
It's just numbers.
Yeah,
I don't worry about that stuff.
No, but I mean that's what I'm hearing internally, and from what I gather, I know that CMHC or the feds, anyways, are looking at tightening up that program. But because that's the only reason why you're actually getting rental housing built. But I guess it's a catch-22 if you're on the other side of it.
So that sort of ties into a couple of questions I have for you, Ben. One is I just sort of want to conclude. So the narrative that you were sharing with us before Steve's question about construction, about number of foreign workers coming in, am I hearing you correctly in that narrative is suggesting that the private sector employment or jobs is actually stronger on paper than what it really is? So it should be a lot lower?
Yeah, that's exactly right. Yep.
So if anything, we probably have net negative. We're not net. We have negative losses in the private sector most likely now. Then that's the trend where we're headed, right?
Yeah. Well, you've got the two different labor force surveys, right? The labor force survey and then the payroll survey, as Rich would know well. And if you actually look at the payrolls, and then you back out kind of the public admin, education, healthcare, it is negative. So private sector payrolls are already declining, even with this, I would argue, this tailwind of artificial demand from this fraud.
Okay. So we have this trend going because, we've been talking a while here on the podcast, and same with us managing our portfolios, what we think is where we're headed, how it's going to affect financial markets, including currencies. Now, during the Bank of Canada presser, Tiff Macklem said they did not expect, or they are not forecasting a recession for 25. He's very, and at the same time, Rich and I were laughing earlier when we were talking about it, that he can't come out and say, actually, yeah, we're probably going to hit a recession next year. So, everyone run away. So we know that's the case. We want to get your thoughts. First of all, will we avoid a recession in Canada? And then he also, I think he referenced it maybe 9 times during the presser, that they've achieved 2% inflation target. He didn't say which one, but we know what they follow. And that's clearly not at 2%, around 2.5, 2.6, I think we are.
2.3 for core and 2.02 for headline.
No, not headline, but if you look at trim in median, I think it's like 2.5.
So, yeah.
That's right. That's their preferred measure. And no one called them out on that. So are we headed to, are they going to achieve their inflation target because we actually have a recession, and demand comes down quite a bit? Like, it's sort of wrap all that together and say, hey, is the economy actually in good shape? We're going in the direction that the Bank of Canada is suggesting, or are you suggesting, hey, they're going to miss a lot of things here? It's getting not pretty.
Well, I think there's a lot more uncertainty right now than I think normal. I mean, there's always uncertainty, but look, Trump is a game changer. We don't know what these tariffs are going to look like, if anything. We don't know. Like, I've got a couple worries around Trump, more related to how strong the U.S. economy could end up being under Trump, and what that could mean for how low the Bank of Canada can actually push rates, right? And then also, I think people forget, in the first Trump administration, he threatened to label Canada a currency manipulator. And so I think having Trump in the White House, there's these additional risks where you could end up getting a lot of pushback from the U.S. administration if the currency falls too much.
I think
that
this
could
morning
force the Bank of Canada to be tighter.
I think this morning he'll be calling the Swiss a currency manipulator based on what they did, but we'll continue.
Right. Yeah. Right. Well, so, this just adds another layer of uncertainty, and obviously the tariffs are a huge uncertainty. Bank Canada gave a nod to that. So kind of setting all that stuff aside, which is a huge caveat, but let's just set that aside for a minute. I think kind of the fulcrum of the discussion has to be around population growth, right? And you finally saw the Bank of Canada acknowledge that. If the feds are serious at curbing population to the extent that they have laid out, it is going to be an enormous headwind to demand next year and the year after. And I think under that scenario, it gets harder to manufacture growth. So look, my bias is still that things are
Ben,
weaker.
how are they then? I mean, we all know the population story, and unless the government goes back on their word, and that's
they would never do that.
Yeah, they would never do that, Rich. But let's just assume that they do stick to their word. So it's like it's a fantasy land now, I guess. But how can the Bank of Canada reconcile that we are going to have a positive economy 12 and 24 months out, given that? Because you need something else to be incredibly strong. Maybe it is the U.S. economy. Maybe they're saying, hey, the U.S. economy is going to be so strong, it's going to, we'll get caught up in the draft. Like, where are they getting it from?
Yeah, I'd have to go back and look at their latest forecast. But Rich, you might be able to correct me. I still think they've got penciled in pretty strong household consumption trends for next year, solid business investment trends, which is the one that I don't understand. Who's going to be investing in businesses with this looming threat of tariffs hanging out there? But then also a pretty decent uptick in residential investment next year, which, who the hell knows? Consumers and home buyers it's a fool's errand to bet against them. So who knows? But it's hard to envision that you're going to get a massive uptick if population is negative. So that seems to be where they're coming from.
But they did reference that the household sector was quite healthy and there was actually increasing spending. Yep. I think I heard that. Did you guys hear that as well?
Well, Ben, maybe.
But they always, sorry, 1 second. They always do it in aggregate, which is exactly, I think, the point that you're trying to get to, Keith, which is they never talk about the per capita spending, which is exactly what I think Ben will eventually lead us to, which is if you have a contraction in population growth and you have no productivity growth and the unemployment rate continues to rise, there's no way that you're going to have an increase in per capita consumption.
That's what they said spending yesterday, though. They
explicitly said I'm calling them
liars. They said one will offset the other. Okay, yeah.
I'm calling them a liar, basically, and I think that. And then, as far as business,
you're calling Carolyn Rogers a liar?
No, I love Carolyn Rogers. I would never say anything bad about Carolyn Rogers. I'm not a big fan of Tiff Macklem, but but I think it's really important, and the business investment piece is crucial here. We in real terms, we are flat in 20 years. And we're talking about the tariffs a little bit later. I think that's a massive red herring. I think the tariffs are something we should basically ignore. I think the taxes and the cut in corporate taxes is really the issue that Canadians should be mindful of with respect to investment. But back to the consumption piece, we know that per capita spending on services, which is the lion's share, has been shrinking and continues to shrink. And so the focus on retail sales growth, which has been okay, but again, in per capita terms, is falling. And so if Ben's right about population growth, I'm not quite as hawkish as he is, but I don't see it at all. And so I don't know, Ben, if I've misstepped there, but what's your
I think that's exactly right. So again, like, my view is I still think there's way more slack in the economy in the Bank of Canada. Yeah, I don't even know. See, I think that they might recognize it, but I think that without saying it, I think they're starting to get leery about the currency implications. And I think they're trying to kind of message that they're going to have to be a little tighter and consider. But in the back of their mind, I think they know they've still got a long ways to go to get rates down to where they need to be. So, that's kind of where I come at it from. It's just these rates are still fundamentally not compatible with the leverage in the Canadian economy, especially as we shift into a new era of dramatically different population growth.
What are you seeing,
how do
Ben,
you
on the household consumption side? Like, what is the state of Canadian households in your view?
Ever been abroad and needed Wi-Fi? Download Saily. Tired of telecom oligopolies ripping you off? Download Saily. Want to avoid sketchy SIM sellers at the airport? Download Saily. Saily might be the only travel app you need. It provides an internet connection wherever you travel and saves you money on roaming fees. It's easy to use, affordable, and reliable all over the world. Saily is the modern, seamless way to get connected without the need for physical SIM cards. With eSIM technology, you can instantly activate service from anywhere in the world. No more waiting in line for a local SIM or dealing with expensive roaming charges. Saily offers flexible plans that fit your needs, whether you're traveling for work or leisure. Plus, you can switch between networks in just a few taps, ensuring you always get the best coverage at the best rates. Whether you're a frequent traveler, an expat, or just someone who wants more flexibility with their phone, Saily's got you covered. No hidden fees, no contracts, just affordable, reliable data wherever you go. Visit Saily.com/Loonie Hour for 15% off.
Well, in aggregate, it looks okay. Retail sales look okay. What's interesting, though, is when you start parsing some of the company reports, particularly the retailers that skew more discretionary, you're still seeing pretty significant weakness. Like you've got Canadian Tire in my mind is kind of a pretty good bellwether for discretionary spending, right? And they're everywhere in Canada. It's an iconic name. And they've had 6 straight quarters of declining same-store sales. And that's with significant population tailwind, right? So they should, like the bogey is kind of 3% growth because the population's growing that much. So if you're growing less than that, you're losing share. Like the population is growing faster than your sales. And they're negative. So I do think that you're seeing, in aggregate, like some signs of softness in discretionary spending. I also think that some of the data is getting skewed by the fact that the highest income cohort is really still saving a lot. And you're seeing like dis-saving among the middle income cohorts, but in aggregate, it looks like the savings rate is still okay. So there's some weird compositional issues, but I don't think it's good, right?
What are you seeing on the credit side?
Credit looks, the way I would describe credit is it's normalizing, but it's not alarming. On the consumer side. So you are seeing consumer insolvency starting to tick up. Interestingly, Ontario just had the busiest month for consumer insolvency filings since 2010 last month. So you were seeing some signs that there's pockets of softness. And I think my view is Ontario right now is kind of the epicenter. It's the weakest housing market. It's the earliest signs of credit stress is manifesting there. You can also see it. There's pockets. If you look at like some of the non-prime lenders, so just not to pick on a particular name, but like an Equitable Bank as an example. And they're a lender that tends to lend to self-employed Canadians, for example, or slightly credit impaired Canadians. And their net impaired loans as a share of their balance sheet is as high as it's been since, well, at least 10 or 15 years, right? So you are seeing these little pockets of kind of softness in the ecosystem, but I think in general the way to describe it is it's still normalizing back to kind of pre-COVID levels, but it's not like there's anything that's blowing up in the system.
I have a question then. So I think earlier you suggest that maybe we could see another 50 basis point cut in January. So right now markets are pricing 25. What could happen between now and then with data points? So we have the employment number coming out and inflation, right? Is there anything else that could come out, maybe that they would have access that we can't see or something that would trigger the market to suddenly say, yeah, actually I think it's going to be another 50? We're like 5.
Yeah, and just to be clear,
January 29th, by the way, for the next meeting. So we're 6-7 weeks.
Well, and the market odds, just to be clear, Keith, it's a coin toss whether they even cut at all. It's like 50% chance that there's 0 cuts and 50% chance there's 25 bips. So there's like nobody pricing in 50 right now. So look, I think I'm just saying I think as we go through the month, the odds of a more than 25 basis point cut are going to expand significantly. I just think the labor market data is going to continue to be soft. You know, the inflation data, it's tough to know because you start to lap like the November and December. If you look at the monthly data, like we're going to see an uptick in the headline number just because of some base effects. Like you had a big decline last December in headline CPI. So, you know, it wouldn't surprise me if we tick up to kind of 2.1 or something like that, maybe 2.2 on the headline. But I mean, it's, in my mind, it's all related to employment. And by the way, just to close the thought, like I don't think that the Bank of Canada is at all worried about inflation right now. Like not at all. I think that, you know, I know you guys are looking at core inflation, but still, when you strip out the shelter component, there's nothing there. It's like it's running at 1%. And I know everyone's like, well, you can't cut it too thin, but like if you're the Bank of Canada, there's a lot of things that keep you up at night, or that in theory could keep you up at night. But mortgage interest cost is not one of them. Like full stop. It's stupid that we have that included in CPI. And the other one's rents. They're not worried about rents. Like the point I keep making is rental growth is going to be like, it's already, depending on what measure you're looking at, it's already zero or declining, but it's going to get way softer because, you know, you look at what's under construction, you have 6% of the housing stock under construction in the rental space. So in other words, you know, as the units that are in the construction pipeline complete, the rental stock is going to expand by 6% over the next couple of years, into an environment where the feds are telling you that net rental demand is going to probably be negative. So all else equal, like you're going to see the vacancy rate go from, you know, 1 to 2% currently up to 4, 5, 6% pretty quickly. So they're just not worried about that.
I'll take the under. I'll take the under on that.
Ben, which markets in Canada have the most sort of rental units under construction? Or I guess which markets concern you the most in terms of, hey, wow, there's a lot of supply building here, and this could be a further decline in rents?
Yeah, BC, Alberta look like they're very overbuilt. The Atlantic provinces actually look quite overbuilt. Again, cyclically. But I'm curious, Rich. So when you say so, where do you think vacancies land?
Well, I think that so I mean, I shouldn't have said that. I apologize. I should have been so specific. I think that the idea that housing pressures will fall off completely, I think is at odds with my view that there are still so many issues with respect to like the flow versus the stock argument, in the sense, right? You had years of overpopulation relative to your housing stock. And I'm just saying it takes years for those numbers to sort of deflate, if that makes any sense. You know, and if you use a big example,
so right now rents are going 8%, right, in the CPI. So like, where do you think they'll land? This is good Twinkie bet. A year from now, CPI rents are where?
Well, I mean, the problem is you have a
feels
year
like
on
easy
year
money
change
on the table.
Well, sure enough, but you've had the reason I think that a lot of the time, like if rents have gone up by 40%, and so the fact that they've gone down by 10 doesn't mean that you're back to trend. It means that we are on the process of returning to trend. And the reason it's going to take a long time is because you had 4 or 5 million people come into this country with no increase in housing stock to absorb that. And I guess so that as that rate of change, you know, that rate of change in my view will start to slow. You know what I mean? You can have a year of negative 2% rent or negative 3% rent, but it means you're nowhere close to where you quote unquote should have been had we not screwed up the immigration file, if that makes sense.
Yeah, I agree with that, but you're not looking at it the way the Bank of Canada is going to look at it. Right. So in their mind, is 7 or 8% a sustainable pressure on rents? Because if it's not, then they're going to look through it.
Yeah.
So if you're right that CPI rents are going to, like, let's put it this way, it's 7 or 8% rental growth right now is not keeping the Bank of Canada up at night. And that's like 40 basis points of headline inflation.
Yeah.
You know what I'm saying? So like, they're not worried about that. And by the way, I'd also push back. Like I keep hearing this, like, oh, we're undersupplied by 5 million units. That's this absurd CMHC number that was floating around. And by the way, where they got that number is they said, you know, these are the units that we would need to have delivered to the market to get housing affordable. And the way they defined affordable is house prices 40% roughly below where they are currently. If you want to get house prices down 40%, that's the number that you need. But you know, I keep hearing this. You know,
I'm glad that
we're so dramatically undersupplied.
I'm glad you noted that, because I've been all over that, and I was like, that's the most flawed academic piece of paper that is not grounded in reality.
But there's another.
Well, think about it this way: if you've got, go, Rich. Please.
No. Oh, I was going to say quickly, just on the. I mean, to me, there's there's a couple of things that seem are contradictory, which is we think that they're going to cut interest rates by another 50 basis points, let's just say. We think that they're going to sacrifice the currency. We think that there's issues on tariffs, oil. We think the currency is going to be the major, bear the major brunt of that Canadian weakness on top of the recession, on top of weak population growth. And yet Canadians import the absolute lion's share of their consumer goods from guess who? America and the rest of the world in a currency that's being massively devalued. And so you can already see those currency pressures come up into in the form of producer prices. There's something called a raw materials price index. Even if you X out oil, even if you X out other things like metals and other ores, you're starting to see food creep up, crop product. And so in my view, you could actually make the case we've already bottomed in core inflation, and regardless of your view on rents, because that's the thing about derivatives and rates of change is rates of change. It's very hard to continue to magnify those rates of change, short of an absolute catastrophic depression. And so that's where I think that people who are like, when Keith makes a joke that they're sort of doing a victory lap on inflation, I would just pump the brakes a little bit because of how much we do import from the rest of the world. I guess that's sort of my view.
Well, first of all, I didn't joke. It was a fact. They did a victory lap. You were very clear about being very happy with themselves. I think that, what we're talking about, they might say our conversation is about an extreme outcome. So whether it's with, aggregate output, employment, population growth, credit quality and all this stuff. And as we're the stewards for financial savings and household wealth, for people across the country. And that's what we need to do. We need to be worried about this stuff. The sense that I'm getting when I listen to these central banks, all of them, except for the Swiss this morning, they were very clear what they want to do. None of them are yet communicating that the world could potentially be going down the path of another crisis moment. Yet for all of us here, we you can line them all up, and then knock them down. The potential for something more serious happening is a lot higher than what it's been before. Because remember, we went from 0% overnight rates to 5%, and now we're heading back towards 0 again. Whether we get there or not. And I think that's what the challenge is. So Ben, you mentioned, you don't think the Bank of Canada is awake at night worrying about rents and stuff like that. I would love to think that they are actually awake at night worrying about something. And my concern is that they're sleeping pretty tight right now. They're getting 14 hours a night of a KIP put in there, and they're not worried. I'm not.
Ben, what is the concern?
I think there's stuff
Loonie?
keeping them up. Well, I think there's two things keeping them up. So I think we had this discussion in the last podcast, but I said at the time, I think that into mid 2025, the number one concern for the Bank of Canada is going to be getting the overnight rate down close to 2%. Because I think that's where you have to get to start avoiding some of the mounting pressures from mortgage renewals.
That's a long way to go
beyond
from
that,
where we are now.
Exactly. But beyond that, then you start getting into concerns around the currency. And I agree with Rich on all of that, but I think that's a conversation for later next year. But so the two things, if I was Bank of Canada, the two things that would keep me up at night, one is the US Fed staying more hawkish and that exerting upward pressure, because that's a nightmare scenario. Like you look at US household debt service ratio still near all-time lows, Canadian still near all-time highs. You get this massive gap between how much Canadian households are feeling these rates versus the US. That matters a lot. So you could see our economy start to really underperform even as the US stays hot. We need lower rates, they need higher rates, and it just forces, it necessitates this big gap between them. But you can't get there if the Fed is staying super tight without decimating the currency. And then to Rich's point, then you get into all sorts of issues around inflation. That keeps them, I believe that's what keeps them up at night. But I think that they view that as like a later in 25 issue. And I think they're probably right.
So by the way, this morning, I don't know if anyone followed, but the Swiss National Bank came out with their, monetary policy meeting, literally an hour before the Europeans did. So the ECB cut by 25 basis points, but the Swiss cut by 50, so half 100. And they caught everyone off guard with that because the expectation was for 25. Did you notice that, Ben? Did you see what they did? You're somewhat.
I saw the
smiling.
headlines.
Okay.
Yeah, I saw
So
the headlines. Yeah.
So the reason, and this ties into this conversation, by the way, is not just like a random boomer story that means nothing. Although there are a few of those, right?
Oh, no,
But
never. They're all great.
never, yeah, they're all great. I forgot where I was going with this. I'm just joking. The Swiss franc has strengthened significantly relative to euro recently. That's the trend it's been going. And, what do the Swiss do for their economy? They export a lot of stuff, specifically to Europe. That's where all of the stuff is going. So they reduced by 50 basis points this morning to explicitly weaken the currency relative to euro. So the conversation that, we're sort of going around now with what are central banks worried about? Will they do something to be proactive or reactive? They absolutely will. And this morning was very important because the Swiss were the first ones to come out and say, hey, we're going against trend here. We need to weaken our currency, not strengthen it relative, to the guys next door. So I think it's already happening here. It's going down that path. And by the way, the ECB, everyone, they always come out, they're very soft and fluffy, and they follow policy and protocol and all that stuff that makes it the way it is. They dramatically lowered their growth forecast for next year and the year after. So they are implicitly or explicitly saying, hey, we're going to have a weaker economy. Implicitly, they're saying, boy, we're in real trouble. And if the American economy stays, somewhat stronger than everywhere else, that's just going to suck capital in from everywhere else, which is going to have an effect up here in Canada. So there's lots of things at play here.
So just to touch on that, Ben. So yeah, we had U.S. CPI data came in relatively hot-ish. U.S. PPI, same thing. You got a 99% probability of a rate cut from the Fed next week, but after that, I mean, it goes down to probably no move in January as of right now. So it's like if you get a situation where the Fed is done as of December. And you're suggesting that, hey, look, the BLC's still got to keep moving. They got to get rates down closer to 2%. It's another 125 basis points from today. I mean, what does that look like? I mean, I just, the Canadian dollar is obviously
it's the Canadian dollar.
Right
yeah,
now.
the loonie gets smashed even more. I think that's ultimately where they have to go. And I don't think they're losing sleep over that yet. I think that becomes, like I said, they're in this race, right? Where, everyone understands there's a mortgage renewal issue coming, right?
Mm-hmm.
And you can kind of track it. You can see there's this big slug of mortgages that were originated between late 2020 and early 2022. Mm-hmm. And we know the volumes, like all that data is out there, how much was originated. And it's the equivalent of about a third of the outstanding mortgage debt. And when you look at the average interest rate, it's like under 2%. So as just a simple mental math, you just go, okay, let's take 2% as an average for that 1/3 cohort that's going to be renewing in 25 and 26. What's the absolute lowest mortgage they could renew into regardless of term? And today you're still looking at like a 25 to 30% hit to the monthly payment from that cohort. Now, that's problematic, man. Like that's if the bank does not get rates significantly lower from here, their outlook for household consumption is it's going to be way wrong, right?
Ben,
so to me, that's what they're racing against.
I'm just curious. I want to push back on that. Just on a research note from CIBC, and again, I want to hear your thoughts if you agree or disagree. But you had Benjamin Tal out last week. He wrote a note saying about 40% of mortgages renewing next year will see lower monthly payments. About 10% of them will see an increase of less than 10%. So that leaves about 50% of renewals next year facing an average payment shock of about 20%. But in their opinion, it doesn't look so scary if you consider the fact that over the last 5 years, both wages and home prices have risen more than 30%. So CIBC estimates that the total payment shock in 2025 will average just 2.5%. Do you agree with that? Is that?
Yeah, that doesn't fully comport. Like, yeah, there will be some that have lower payments for sure, because you got to remember, you've got 1-year mortgages that are now rolling, 2-year mortgages that are renewing, and they'll be lower than they were. Man, I just keep looking at that one cohort. Like, to me, that all eyes need to be on that particular cohort, and the math within that cohort is really simple, right? And you can don't have to take CIBC's word for it. You can pull the data directly from Stats Canada. And that's a third of the outstanding mortgage debt originated in that 18-month period at sub 2% rates. So,
Yeah.
the math is what it is. I don't think CIBC, man, I'd push back a little bit on that, but we'll see.
Lowest rates today, probably fixed rates, probably around 4.2 ish.
Yeah.
There's also one more thing just on, so we talk about the numerator, denominator, but I think that when we're thinking about wage growth, and that's often cited, wage growth is really strong in Canada. I think it's really important that we remember that 45% of those new jobs have been created in the public sector. And, to cite another bank's work, which is Desjardins Bank, came out in the summer, and they have a huge paper and says, the name of the paper is How Government Compensation is Keeping Wage Growth High in Canada. And so I think we need to start being a little bit more nuanced with respect to like who's getting that wage growth and who's not, and if that wage growth is keeping up with what I agree with Ben fully, which is a huge sort of increase in their mortgage payments, et cetera, and more importantly, the knock-on effects to consumption and services and et cetera. So just something.
But speaking of the wage piece, though, did you guys see I might say you guys the chart, but if you look at permanent workers and you look at wages in the most recent labor force survey, first off, the annual growth rate fell to 2.5-year lows. But if you look at just the 3-month trend, it's like the lowest we've seen since the pandemic. We actually had a 0.6% decline in wages last month, which is the steepest since we had lockdowns in 2021. So again, that to me is just more sign that there's more slack in the labor market than what the official headline number suggests. And I don't buy that those wage gains are going to be there.
Yeah, I agree.
Ben, is this a vibe session or a recession?
I actually tried to order a shirt that said vibe session. You guys should have that for merch.
Good. Yeah.
That would sell, man.
Yeah.
Of course,
it's the best idea we've had in a while.
Hey,
Sorry?
man, that one's free.
It's a recession.
Sorry, Ben.
What are you in the recession camp? Or are you kind of like, we're not, maybe not? Pelosi certainly thinks we're in a recession.
Yeah, no, of course, it's more than a vibe session. The data is really clear. This is not just sentiment. It's a lot more to that. But that said, there is an element to it where you're starting to see sentiment roll back over again. So if you look at the consumer confidence data, we've seen the steepest 4-week decline in consumer confidence we've seen since the pandemic. And what's driving that is all of a sudden there's a lot of concern around job security. Right? What's driving that? Right? So again, I just think all of it points to just a much weaker economy than the headline numbers suggest. And it's clearly a recession. It's not a vibe session. That's bullshit.
Ben, as we wrap up here, we want to be respectful of your time, but as we move in, end of 2024 here, moving into 2025, just to kind of summarize, is there are a few couple key things that, the listener should kind of keep an eye on in terms of the direction of the economy, housing? What are the sort of key themes that you're keeping an eye on?
Well, rates and population growth are going to be big ones. I think you're going to see a decent uptick in home sales over the next 6 months from these lower rates. There's clearly some pent-up buying pressure. Even as you're seeing weakening rental market trends, I think that's going to persist into the spring. Beyond that, I think the outlook, it's a lot cloudier because then you start running up against, who knows what's going to come out of the U.S. administration. I think that's when you start running into issues around, will the currency start to matter in the whole inflation fight? I think things get a lot more challenging after the spring, at least on the housing front. And then, we'll see. But my view is still just that this labor market data is just much softer than the headline suggests, and it's going to force Bank Canada to continue to loosen.
Is the bond market going to play ball in terms of, lower mortgage rates? Obviously the BOC could influence variable rates, but fixed rates have been pretty sticky.
Yeah, they have. And that's, I think in some part, that's getting back to this kind of real pickle that Canada finds itself in that the US just is not playing ball economically. They still look really good. And if US rates are still staying that high, who's going to lend to Canada at whatever 3% if they're getting I don't know what the 5 years.
But we have the
the
lowest
answer,
net debt.
I have the answer. It'll be the Bank of Canada. That's who we'll be lending to.
Yeah, exactly.
But Ben, we have the lowest net debt to GDP in the G7.
Oh God,
I've heard this
Yeah.
on good authority. Net debt to GDP, folks. The last refuge
Yeah.
of a scoundrel.
First central bank to cut 7 times or whatever
Yeah.
in the G7.
yeah.
Well, any final parting words, Keith, Rich?
What is your favorite Christmas movie? That's not Die Hard.
You know, it's a really good one that we've gotten into that's kind of become a bit of a classic is Christmas Chronicles on Netflix. You guys seen that? It's got oh God, Kurt Russell as Santa.
Oh yeah.
Okay.
Oh, it's great.
I like
He's
that.
great. It's actually a
What?
really cute.
Is that a new
family
movie or
Christmas
old
movie.
movie?
No, like within the last 5 years.
Okay.
And then beyond that, you got to go back to like the original.
Is it
claymation.
PG-13? We have Rich on here, right? Is it?
Oh no, it's
acceptable?
It's safe. It's PG.
Okay,
It's PG.
good.
Have you
But
seen?
beyond that, you still can't go wrong with the original claymation Rudolph. That's still a classic.
Oh, that's a great
That's a good one.
movie.
Have you seen
That is a
Daddy's
good one.
Home
So good.
too?
Nope.
Yeah.
That's
He's
a
the only
classic.
one.
I watched that with Mrs. Icecap.
Oh boy, Ben, we appreciate it as always, man. Thanks for coming on. Bob Sakamoto, everyone's favorite Loonie Hour guest. We'll have you on, and looking forward to the next live Loonie Hour event at your cabin. It's going to be a banger. So thanks again for coming on.
Looking forward to it, guys. Have a good one.
That was another good interview. I think we can all agree we're a little bit scattered on that one, so I do apologize. I think we were so excited to get Ben on the show. We had so many questions, and
Well, you guys were scattered. I was laser focused. I know exactly where we're going. But the great thing about the conversation, though, when we have Ben included, I hope people are able to have a better a view or visibility of exactly what the economy looks like when you're tearing it apart, and what the Bank of Canada might be thinking about, and policymakers, and the dilemma they have with doing one thing over another. But overall, we keep talking about which trend are we headed in, and stuff like that. And I didn't hear anything from Ben that would suggest to our management strategy, portfolio management strategy at IceCap, that, oh wow, we need to change this around. I think Canada is headed towards an unpleasant experience. And if we do get this national recession, which I believe we're going to get, people are not ready for it. I think it's going to be hitting really hard. And then the Bank of Canada has a decision to make, and they'll let the currency go first. I mean, they're not going to do what the Swiss did this morning.
I mean, I think there's no denying that, like, regardless of one's political views, the state of Canadian economies and its financials are just it's in complete disarray. I mean, we're finally getting a budget announcement from our finance minister on Monday, which is several months behind schedule. It's been leaked to multiple credible reports that they had a $40 billion deficit. That was the guardrails. So Freeland says we will not exceed a $40 billion deficit. The rumor is that it's going to be around $60 billion. So we'll find out on Monday. But of course, this comes at a time when we've got the GST holiday, which is going to cost another $6 billion towards the deficit. And apparently there's now leaks in the Globe and Mail saying that Trudeau is trying to get rid of Freeland because she was not on board with the GST holiday. And so it's just a total mess what's going on. And it's, yeah.
But I keep talking about, I can change government I can turn Canada around in one weekend. And I'm very sincere and serious about that. But to give an example, it's completely unacceptable for our government to decide to give us a financial update whenever they want, at whatever time they want, based on what's happening. I mean, if companies can do it quarterly, the government should be doing it quarterly. They have all the data, they have visibility, they should be exactly in line. And that's how you instill better confidence, right? Because we're all voters, we're residents, citizens of Canada. And, I don't think anyone really cares which political party is running the country. all everyone wants is a nice, solid job, your family to be happy and healthy, and that's it. But as we continue to see stresses in the economy and households and whatnot, that's when you step up and you provide more visibility. You don't delay a financial announcement, by weeks on end when everyone knows how it's going to look. But instead, Steve, if back in Q1 they came out with their announcement, oh, this was this is what we were forecasting. We're actually behind a little bit right now, and this is how it might impact in Q2 as we come up. Then you don't run into one of these, gotcha moments, which everyone is clearly expecting here on Monday. And I think you said 60 billion.
That's the rumor. I think it's some MPs leaked it to reporters, and we'll see. I mean, again, maybe it's 45, maybe it's 50, but it certainly seems like it's going to exceed those guardrails, and that's you're just seeing more and more of the chaos. I think that this current administration, which is there's all these MPs that are trying to get JT out of power and out of seat and asking him to step down. He's refusing to do so. He hired Freeland. Now he's trying to get rid of her. Like it's just a mess. And then she's gonna go. Well, she's got to go and announce the budget on Monday. And if it's $20 billion worse than it was supposed to be, and she's like, well, I don't even get to make the decisions. This guy's not even listening to me. I mean, to be honest, sounds like she's getting tossed under the bus, but
the reality is you're both right. And you're both right, but I think you're dancing around sort of a larger issue, and it's the issue I keep coming back to over and over again, and it's investment and productivity. And all of the fluff that we hear from this administration, all of the nice words and the pontificating and the moralizing that we are constantly fed, it does not improve productivity growth in Canada. And unless you do that, unless you encourage people to invest, whether it's through tax cuts, whether it's through making it a more appealing place with respect to regulation, whether it's leaning into the natural resources that we have, unless that changes, we are going to just take a giant bite out of a shit sandwich. And that's ultimately, I think that's what's going to happen. And I think, Ben's right. It's the currency, and you're right, Keith. It's unacceptable that we don't have a fall statement in the fall.
So for the next government, where it's the same, mix that we have now, or new, a suggestion, come out with a quarterly update for everyone. And what Rich was alluding to, there's some pretty easy things Canada can do, and we can turn this country and economy around and become one of the greatest that we'll see in decades. It's so easy. It's incredibly easy to get it going.
Well, just to Rich's point, I know we're getting close to wrapping it up here, but so we just had an announcement from the Trump administration today saying that they're going to be cutting corporate taxes to 15%. So I'm just wondering, how do you, Rich, you're saying there's already an investment crisis in Canada. What businesses are going to come here and invest and start new businesses when you got the US offering a 15% corporate tax rate?
Well, I'm really happy you brought that up, because there's so much bloviating over this tariffs business. And I think that people are totally missing the trick. And Steve, I think that that's really, the issue. The real issue is not tariffs. I think that they get a great headline. I understand it's a soundbite. Doug Ford had sort of embarrassed himself by saying Canada's not going to export energy. Energy is our largest export. Of course, we're going to export energy. 97% of it goes to the U.S., as Heather, one of our better guests, has alluded to. But that tax rate, to me, is really, that's the danger. And it's the danger because it will increase the trends that Keith's already talked about and accelerate those trends, which is a lack of foreign direct investment and an acceleration of Canadians investing in America, which we need to sort of deal with. It will exacerbate the decline in investment in construction, machinery, equipment, and intellectual property products, which is what you need for productivity, which is what you need to increase people's wages, disposable income, and to pay taxes and to pay for shit. And so for me, forget the tariffs. The tariffs is a bullshit headline that people are really obsessed with. That corporate tax cut in America, a place that's already better to do business in Canada, should terrify Canadians. And we need to respond. I don't know. That's a much trickier question, Keith.
Yeah.
Me? Anyway. Should you say me or Steve? Who would you refer to then?
I said Keith, because you said it's really easy to fix Canada's problems. I think it's much, much more difficult than that. I don't agree. I think it's much more difficult to fix Canada's problems than you're making it sound.
No, it's easy. However, because of the way government is put together, you need buy-in from a number of different groups, and we've all seen, the witness expert protection program. They bring people in to testify in front of, which is a shit show. It adds no value whatsoever. It's one of these things where you know what you can do. It's so incredibly easy, but yet there is zero chance it would ever happen. Again, like the idea of come out with a quarterly review for your economy. Again, you're the Finman, you should be doing this. Absolutely. If you're doing it internally, which I would imagine they are, why can't they release that to the public? They work for us. They're not working for themselves, amongst themselves, their own stakeholders and so forth. And once you start changing the way that you do business, you can call it business, whatever you want. That's what's going to increase confidence for foreign investors to come in. Just little small things. But as you said, Rich, like, obviously the Americans have a lot of momentum right now because of the election, some pretty dramatic changes that they're going to make. And are they going to work? Yes or no? I don't know, but at least they're trying to do something. And if I had to say allocate, $400 million to build a manufacturing plant of some kind, which place on earth am I going to put it right now? It's America. That's where it's going. So again, all of this suggests that we could see this amazing experience where you're having billions of dollars just flooding into America and it's sucking it out of everyone else around the world. And that US dollar goes through the roof, the stock market could go through the roof, treasury yields could go to zero. I mean, you name it. You could have this amazing experience, or maybe it won't be as great as that, but they're going for it. And as of right now, everyone else around the world, we're just trying to protect what we have. We're actually saying,
well, we're navel gazing. We're doing worse than that.
Yeah, we're saying what we're already doing is fine. You don't need to mess with this stuff.
We need to tax energy.
Sorry, I know where I would vote with my money right now, and that's what we're doing.
Well, that's the beauty of financial markets and capitalism. Okay. So we'll wrap it up there this week. Hope everyone enjoyed the interview with Ben. We'll have him on again, and then we'll maybe we'll dial in our questions a little bit more. But appreciate the support as always. If you got any sort of value entertainment from this episode, I'll be asked that you share it with one friend, one family member as we get into the holiday season and continue to expand the Loonie Hour one by one. So as always, appreciate it, and we'll see you next week.